Tonight, when you check your bank balance, pause for a moment. That number, the money sitting there, earning almost nothing, waiting to be spent, exists inside a system that was designed in secret. Not by a government, not by elected officials, by 6 men on a remote island off the coast of Georgia in November 1910, and not one of them used their real name. The story of the Federal Reserve is usually told as a story of stability, of progress, of a government finally getting serious about protecting the financial system. But that is not the whole story. The whole story begins with a cover-up, a borrowed shotgun, and the most powerful private meeting in American financial history. Here is what really happened. By the early 1900s, the United States had one of the fastest growing economies in the world and one of the most chaotic banking systems. Between 1863 and 1910, there had been 3 major national banking panics and at least 8 more localized ones. Banks failed without warning. Depositors lost everything overnight. There was no safety net, no lender of last resort, and no coordinated response when things went wrong. The breaking point came in October 1907. It started with a failed attempt by 2 Wall Street speculators, F. Augustus Hines and Charles Morse, to corner the copper market. The scheme collapsed. Their banks were exposed. Depositors panicked. Lines formed outside the Knickerbocker Trust Company, then the 3rd largest trust in New York City. On October 22nd, depositors withdrew nearly $8 million in a single day. The next morning, Knickerbocker closed its doors entirely. The shockwaves moved instantly through every connected institution in the country. The stock market lost nearly half its value from the year before. Factories cut production by 16%. The real gross national product of the entire United States contracted by 11%. And because there was no central bank, no institution with the authority and resources to step in, the job of saving the financial system fell to one private citizen. J.P. Morgan was 70 years old. He locked the heads of New York's major banks inside his private library on Madison Avenue and refused to let them leave until they agreed to a coordinated rescue. He spent his own money. He organized other wealthy men to do the same. And it worked. The panic was contained. But that was the moment lawmakers and financiers alike understood something frightening. The stability of the American economy rested entirely on one man's willingness to act, and one man would not always be there. Congress responded by creating the National Monetary Commission, chaired by Senator Nelson Aldrich of Rhode Island, to study the banking systems of Europe and recommend a path forward. Aldrich spent 2 years in Germany, France, and England studying central banks. He came back convinced that America needed one. The problem was political. Any plan openly associated with Wall Street bankers would be dead on arrival in Congress. So they decided to write it in secret. In November 1910, 6 men boarded a private railcar in New Jersey under a single rule: first names only, no last names. Not within earshot of the waitstaff, not within earshot of anyone. One of them, believed to be Henry Davison, a partner at J.P. Morgan, carried a borrowed shotgun to sell the cover story. They were going on a gentleman's duck hunt. That was the story. They were not hunting ducks. Senator Nelson Aldrich was there. A. Piatt Andrew, the Assistant Secretary of the Treasury, was there. Henry Davison of J.P. Morgan was there. Arthur Shelton, Aldrich's private secretary, was there. Frank Vanderlip, the president of National City Bank, what is today Citibank, was there. And Paul Warburg, a partner at Kuhn, Loeb and Company, and one of the most sophisticated banking minds in the world, was there. They traveled to Jekyll Island, Georgia, where the exclusive Jekyll Island Club, described by Munsey's magazine in 1904 as the richest, most exclusive, most inaccessible club in the world, had been arranged for their use. J.P. Morgan himself almost certainly facilitated the access. And for 9 days, these 6 men, representing perhaps a quarter of the entire world's wealth between them,
drafted the blueprint for what would become the Federal Reserve System. Paul Warburg was the intellectual engine of the meeting. A German-born banker who had grown up inside Europe's far more sophisticated central banking tradition, Warburg had been warning for years that the American system was fragile beyond reason. He had written extensively about the need for an elastic currency, money that could expand and contract with the economy's needs, rather than being locked to a fixed gold supply. At Jekyll Island, his ideas became the architecture of the plan. By the end of the 9 days, the group had designed a Reserve Association of America, a single central bank with 15 regional branches across the country. Each branch would hold the reserves of its member banks, issue currency, discount commercial paper, and clear checks. The plan was comprehensive, and for 20 years, not one of the 6 men admitted the meeting had taken place.
Here is where the story gets strange. When Aldrich's plan was introduced in Congress, it was rejected, not because of its content, but because of its author. Aldrich was too visibly linked to Wall Street, too obviously a creature of the financial elite. By 1910, the Democrats had swept the House of Representatives, and progressive reformers were furious about the unchecked power of the banking industry. An Aldrich plan was a banker plan, and the public knew it. So, the plan was rewritten. The name was changed. Aldrich's name was removed entirely. Virginia's Representative Carter Glass introduced what was now framed as a Democratic reform measure. Senator Robert Owen of Oklahoma co-sponsored it. Woodrow Wilson, running on a platform of economic reform, endorsed it. It was presented to the American public not as the work of 6 men on a private island in Georgia, but as a democratic solution to protect ordinary depositors from the power of Wall Street. On December 23, 1913, while many senators had already left Washington for Christmas, the Federal Reserve Act passed and was signed into law by President Wilson. The structure that emerged, 12 regional banks, a board of governors, a mechanism for controlling interest rates and money supply, was virtually identical to the plan designed in secret on Jekyll Island 3 years earlier. Frank Vanderlip, the National City Bank president who had attended the Jekyll Island meeting, later wrote about it openly. He called it one of the most important financial meetings in American history. He acknowledged the secrecy. He acknowledged the reasoning. If the public had known that the architects of American banking reform were the very men who had most to gain from its design, the plan would never have passed. That acknowledgement matters, because the Federal Reserve is not a conspiracy. It is a functioning institution that genuinely stabilized a chaotic system. But it was built by people with interests, and understanding those interests explains a great deal about how the system works today. The Federal Reserve controls the federal funds rate, the interest rate banks charge each other for overnight loans. That single number ripples through everything you touch financially. When the Fed raises rates, your mortgage gets more expensive, your car loan gets more expensive, your credit card interest rises. When the Fed cuts rates, borrowing becomes cheaper. Asset prices, including houses and stocks, often rise. Your savings account, meanwhile, typically earns close to nothing, regardless of what the Fed does, because banks profit on the spread between what they pay depositors and what they charge borrowers. If you are finding this valuable, this would be a great moment to like this video, subscribe to After Tax Academy, and hit the notification bell so you never miss an episode. Understanding how money actually works is one of the most powerful things you can do for your financial future. Here is the counterintuitive part that most people never learn. The Federal Reserve is not a government agency. It is a hybrid. The Board of Governors is a federal agency, but the 12 regional Federal Reserve banks are private entities owned by their member banks, institutions like J.P. Morgan Chase, Citibank, Bank of America. The same financial institutions whose predecessors designed the system in 1910 still sit inside it today as shareholders. Economist Milton Friedman spent decades analyzing the Federal Reserve's record,
and concluded that the Fed had actually made the Great Depression significantly worse, not better. By tightening money supply at exactly the wrong moment, the Fed contributed to a banking collapse that destroyed savings accounts, shuttered businesses, and put millions of people out of work. Ben Bernanke, who later chaired the Federal Reserve and won the Nobel Prize in Economics, acknowledged Friedman's finding directly in 2002. He stood at Friedman's 90th birthday celebration and said, "You are right. We did it. We are very sorry."
That is a remarkable admission. The institution designed to prevent bank runs helped cause the worst financial collapse in American history. And yet the Federal Reserve survived. It adapted. It expanded its mandate. Today, it manages not just interest rates, but employment targets. It conducts quantitative easing, buying government bonds and mortgage-backed securities to inject money into the economy. It acts as the lender of last resort, the role that used to fall to J.P. Morgan alone. The 2008 financial crisis tested the system again. Bear Stearns ran into trouble in almost exactly the same way Knickerbocker Trust had in 1907. A shadow bank with too much leverage and too little liquidity, facing a sudden loss of confidence. The difference was that in 2008, the Federal Reserve stepped in immediately. It facilitated J.P. Morgan Chase's acquisition of Bear Stearns with a loan. It cut rates. It injected trillions of dollars into the financial system.
Whether that was the right response is still debated by economists. Whether it helped ordinary people or primarily protected banks and asset holders is a question that shapes political arguments to this day. What is not debated is that the response was made possible by the institution designed on Jekyll Island in 1910. Here is what this means for you. Every financial decision you make happens inside the system those 6 men designed. Your mortgage rate is determined in part by what the Fed decides at its 8 annual meetings. Your savings account earns almost nothing because the Fed creates the environment in which banks choose what to pay depositors. The inflation that shrinks your purchasing power every year is the direct result of how the Fed manages the money supply. Even the job market you enter, stay in, or leave is influenced by the Fed's calculations about employment and growth. Paul Warburg believed that without an elastic currency, without a central institution able to manage the flow of money, the American economy would keep destroying itself in cycles of panic and collapse. He was probably right. The decades after 1913 brought new crises, but the system of total bank runs that wiped out depositors without warning gradually gave way to deposit insurance, regulated reserves, and managed liquidity. But the design still reflects its origins. It was built by bankers. It was built to serve the needs of a banking system, and it has spent more than a century doing exactly that, sometimes in ways that protect you, and sometimes in ways that protect the institution more than the person standing at the end of the paycheck. When you open your bank app tonight and check that balance, you are looking at the output of a system designed in 9 days on a private island by men who traveled under false names and shot at ducks they were never trying to hit. They built something that lasted, something that changed how every dollar you earn, spend, save, and borrow actually moves through the world. The question worth sitting with is not whether the system was secretly designed. It was. The question is, now that you know how it works and who designed it, what do you do differently with your money inside it? That is not a rhetorical question. The answer to that question is exactly what this channel is here to help you find.